Hi, folks. So let's go through a case study. Let's say you are really excited about an IPO, and you have been waiting for months for that IPO to come. There has been a great buildup of the narrative in the market, how exciting this IPO is, and how lucrative it would be for its investors, and what kind of crazy money that you're going to make out of it. So you're totally convinced that you will be able to make some quick bucks with this new IPO, and you are uh, you celebrate the allotment of that 2150. You know which IPO I'm talking about. I will also disclose it later. So 2150 is your IPO price. You apply in all your family names and extended family names, the number of IPO filings that you could do. And you have the listing day. The breaking news on that listing day is that the shares closed 27% lower from the issue price on the listing day. So, you have this palpitation that you've leveraged. Even if you've not leveraged, you've put in decent amount of money across different uh, accounts, and you have lost 27% on day one. Now, of course, you can guess the stock. We are talking about Paytm. Uh, Paytm shares closed in November 2021 at 27% below the listing day. So you are shocked. You are because the narrative was such that this could not have happened. There is no way this could have happened. Uh, Classical investors, all mutual funds, everybody has invested in this stock. There is no way you could lose money with this. 10 days later, it falls. The Paytm stock keeps falling. 10th day in a row, new all-time low again. Nobody really knows what's happening, right? So where have all the buyers gone, and there's only sellers in the market? You are, of course, in deep distress. And within 4 months, you've lost 73% of your capital. I mean, that is just a very crazy number that a new stock comes to the market with all the fanfare and the prospects of digital India and how the next 20 years are going to be glorious. And then in 4 months, you're sitting at a 73% loss of your capital. It's all about the game of human emotions. How we perceived the IPO in the first place, how we reacted to that IPO in terms of our applying or not applying, how we reacted on day one when IPO opened, the listing happened, whether we should have sold or not sold, whether we added more money as it went down. All these are emotional points. So let's go through some of them. First couple of days of listing, stock cracks to about 1280, 1300. You're telling yourself, don't worry, it happens. I'm sure the stock will recover. That's the first human emotion that comes around, that you are trying to convince your own self that nahi nahi sab kuch theek hai, don't worry about it. Drawdown already is 35%, and you need 54% jump in the stock to now even recover your cost price. I'm not even talking about opportunity cost here. Okay, that has happened. Then few days later, stock actually has a bounce, and you are feeling, you're thumping your chest and you're saying, I told you I'm going to make a handsome gain out of it. And I'm telling everybody around me, see, you were telling me that Paytm listing is no good, but I'm showing you today that it was just a blip on open, and now you see we are going to 3000 and 4000. Right? You are celebrating at the party and asking people to buy now. We are still 5% down, only 5.3% to recover from where we are. Okay. Few days later, maybe less than even a month, it still comes back to the same bottom as it made here. Here you are kind of telling yourself it's made a double bottom. Now it will go up. This is the worst it came last time also. This is where there is going to be an upward rally. So you are now again at 35% drawdown to recover 54% from there. Another month later, you have one bounce, one day of bounce, and that one day of bounce feels like you found water in a desert. Uh, that it's a decent bounce, it's a strong bounce, there are great volumes. You try to convince yourself with all the positives that are being spoken on that day, that let's try to wait and we'll exit at uh, at cost at least. So let it come back to cost. So have you seen the change in your own behavior from day one till, let's say, 2 months? From day one was, I'll buy at 2150, I'll sell at 3000, 4000. A month later, you are like, okay, this stock is not so bad. It will recover. We'll make some money. 2 months later, stock is down 40%. You're saying, I want to recover my cost. And this was maybe a 20-year plan that you had, a 10-year plan that you had, a 5-year plan that you have. But in 2 months, your emotions have taken you from this being a multi-bagger of your life to recovering cost for you. This is how emotions play a game with our decision making. So now at 40% down, you need a 67% rise in recovery. We are in middle of January now. Okay, few months later, stock continues to go down. Continues to go down. We are now at 62% down. To recover, we need 163% recovery. Another month down, we are down 70%. We need 233% recovery. Now you are now you sort of starting to give up. You're saying this stock is just not stopping, and I've already lost 70 rupees out of 100. This 30, I don't really care about it now. Let it just be in the portfolio. We will see when it happens. A lot of folks will be doing that. Now, if you see from day one till here, whatever may have been your exit criteria, if you had one. See, first of all, most people will not have one. 99% people will not have one. The idea is that you must have at least some exit plan. Maybe once it made a bottom here, the next time it breached this bottom, this should have been your exit. Maybe after the next leg down, when it breached this pivot, it should have been your exit. Maybe some criteria of some kind should be there. You cannot keep hoping against hope. So the idea is that you are putting up your capital, which is, I am presuming, you work very hard for your money. Everybody does that, right? Very few people have it just have it easy. Okay, I got some inheritance. Okay, now I want to blow up that inheritance. That may be a special case for some, but most people are working very hard, and they want their money to work even harder to make sure that they have a great retirement. They have great achievement of their goals for themselves, for their children, so on and so forth. So you have to treat it very, very seriously. I mean, this is not a joke. I mean, all the hard work that you did to make that 100 rupees has now gone to waste. I mean, you've lost 70% of that, right? So the question that I want to ask you is, does that stock, I'm not talking about Paytm in general, I'm just saying in general, any stock where you are willing to sit out and have the stock bleed to death, does that stock deserve your hard-earned money? That is the question. Ask yourself, are there are there ways? Should I have been more careful? Should I just allow my hard-earned money to bleed like this? The stock went from 2000 to 500, and then there was a rally towards 960. Warren Buffett, all these names came through, and the Paytm Bank is coming through, and they're going to do wonders. So people averaged in this rally. Those who were stuck here, most of them averaged here. And then there was news that Warren Buffett is getting out. The original promoters, the Japanese investors and promoters are also diluting stakes. Big news are coming out. Suddenly 960 to 308. Some license has been not renewed, uh, so on and so forth. So crazy kind of losses, and not just monetary loss, it is going to hit your confidence level in a very big way. That my assessment was so wrong that I could not see this coming. What kind of an investor am I? You have to assess yourself. I mean, after all, you are the fund manager of your portfolio. If you are selecting stocks that go 70% down, it is egg on your own face. It may sound harsh, but that's how it is. So you have to perform for your money, for your family, right? So you have to allow the stocks to tell you that they deserve your hard-earned money. The stock has to tell you. You will not make that decision. The stock will make that decision. You will only follow that decision, right? Now let's take another case, Zomato, Zomato, whichever way you want to call it. Again, same case, 75% drawdown. At every point, people are saying, great company, great promoter. Yes, everything is great. Stock is not performing. If everything is great and stock is not performing, you don't have to be there. If everything remains great and stock does not perform, how will you make money? That eventuality that yes, someday this will not change, this will change and stock will not further drop. That eventuality, when it comes, we will buy the stock again. Like for instance, I'll give you another example, global example right now. Baba, I should have put a chart here. It's been dropping for the last so many years. It has zero returns to show for last 8 years now. But it is great in value. It is having great, cash per share, fantastic earnings. The stock is not moving. What is the rush? Let the stock move. We will buy it then. Anyhow, coming back to this, so when we compare Paytm to Zomato in their initial days, November 21 to January 23, they were identical, actually identical. Somehow, you know, we don't see them as equals, but the trajectory was very, very identical. And things changed post 2023. Something happened where after 2023, Zomato went up 300%, while Paytm lost 17%. From January 23 till now, which is about 18 months, a remarkable dramatic change happened in Zomato, while Paytm actually lost even more ground. Potential earning points, entry points in Zomato. So while it dropped like Paytm, there were breakouts that were happening, right? So there was a consolidation phase, almost a U-shaped recovery, a resistance breaking here, maybe even some moving averages were getting broken. So there were ways in which you could have said that, okay, this is now worth taking some risk on. Maybe some key pivotals, once they broke, you could have, some trends were going up. It eventually made a all-time high also. It made a 52-week high somewhere near I think June. It made a 52-week high. So these were all signs that the stock has lost its losing journey, and it is now on a potentially upward journey. These are signs. These are actually data points, not just even signs. These are data points. And to read that data point, you have to be open-minded, and you need to be practically oriented in terms of accepting those data points and saying, yes, this stock is telling me it deserves to be in my portfolio. For instance, NNF10 entered Zomato at 84 rupees. NNF10 is a strategy that we run on top 10 on Nifty Next 50 index, and there it has 10 stocks in it. That strategy identified this trend, and the fact that it had hit a 52-week high, and that Zomato was versus the rest of the 49 stocks in the Nifty Next 50 space, its momentum score was higher. So we were able to identify that this stock is showing potential despite this. When this was happening, we were not invested in it. But when this was happening, you got invested here. And once you invested, then the stock has to tell you when to get out. And it is just continues to go up here. There was a correction and it's at 186. So we're still sitting on 121%. I don't know if it comes down and we'll get out, or it keeps going up. I don't know. So this is the beauty of, allowing stocks to tell you what you should be doing with that stock. And this I want to make very clear. There is no grudge against any stock. I am sure if the conditions are right, and maybe if the promoters have some new vision, maybe Paytm will become the next Zomato also. But why should I buy it today? Let it prove to me that it is willing to go up, that my hard-earned money is deserved by this stock. It has to prove to me. Once it proves to me, I'm willing to bet on it. I have no grudge against, if Paytm's name was Zomato and Zomato's name was Paytm, I don't care. As long as they are showing the potential to go up, I'm willing to buy them. That's the sort of message that I want to give you through this video. Buy what goes up, sell what goes down. This is the mantra of momentum investing. This is not trading. This is investing. This is actually seeing what is happening in front of you and not imagining something in the future that may or may not happen. This is actual on ground. Like when you drive a car, You are seeing through your windscreen what is there in front of you, right? You are not driving the car looking at the rear screen, or imagining how the traffic or the next car will behave. You're not imagining anything. Your vision is, if I am on this road and this is how, the road is turning, I'm going to turn along with it. I'm not guessing what happens next. That's all for this. Thanks. Bye.